A deal worth more than $70 million, a multi-step corporate structure, and in the end, the CRA could not collect from the company, so they came after the owner personally. This is what the court examined in Patel versus the King, is a 2026 Tax Code of Canada decision. At first glance, the structure looked organized. Shares moved through holding companies. Value moved across entities. Everything looked planned. But the court focused on one simple question. Where did the value go and where did the tax stay? Let's walk through it step by step. Dr. Patel personally owned shares of Allied Canada. He transferred the shares to his holding company and received shares of that holding company in return. The court did not make findings on whether a Section 85 rollover was used. It also did not address whether the lifetime capital gains exemption was available or even claimed. What mattered was what happened next. The holding company, not Dr. Patel personally, sold the operating company to a third-party buyer. That sale created a large capital gain, and that gain created a corporate tax liability. That tax belonged to the holding company. Now, here is the turning point. The holding company did not pay that tax first. Instead, value started moving out. Dr. Patel received value in the form of cash, promissory notes, and shares, while the company still owed tax. This is where Section 160 comes in. In simple terms, Section 160 allows CRA to say, if a company owes tax and transfer value to a related person, instead of paying that tax, we can collect that tax from the person who received the value. Think of it like this, in simple terms. If someone owes money and transfer their assets to a family member instead of paying that debt, the creditor can follow that value and recover it from the person who received it. Now, here is the most important part. How much can CRA actually collect? You see, Section 160 applies a cap using what is called the lesser of test. That means the liability is limited to the smaller number of the company's unpaid tax and the extra value that moved to the individual. And extra value simply means what you received minus what you gave. So in practical terms, CRA can recover the real economic benefit that moved out, but never more than the unpaid tax. Now, once you understand this, the rest of the case becomes very clear. Now, let me quickly introduce myself. My name is Amandeep Singh, a CPA, and I run Cloudiverse CPAs here in Burnaby. At Cloudiverse, we help business owners navigate complex tax situations, almost like Google Maps for tax, so you can see risk before CRA points them out. Coming back to the case in hand. The next key question was, what is the real fair market value of what Dr. Patel received? Because if full value was given, Section 160 would not apply. And this is where expert evidence became central. Both sides relied on valuation experts. The court's conclusion were closely tied to the tax liabilities sitting inside the holding company. Now, because the court emphasized a practical point, a knowledgeable buyer would always consider that tax liability. So if a company owes significant tax, its shares are worth less. Once the court adjusted the value on that basis, it showed that more value had moved to Dr. Patel than what had effectively been given. That difference is what triggered Section 160. Now, another important layer. This was not a single transfer. Value moved through multiple corporations. The CRA argued, based on micro properties, that Section 160 applies to successive transfers. That means the rule can follow through a chain of entities until it reaches the individual. The court accepted this. Timing also mattered. Earlier transfers happened before the tax liability arose. Later transfers happened after the liability already existed. Section 160 was applied to the later stage when tax was already owing and the value was still moving out. There was also a procedural issue. The CRA initially accepted a higher valuation and later changed its position. The court allowed that change because it helped determine the real issue. At the same time, the court addressed fairness. It found that any prejudice could be compensated through cost and ordered the CRA to cover additional expert and pre-trial work. The court also clarified that admissions and pleadings are not always binding if they prevent the correct result. The minister also raised GAR, which is a general anti-avoidance rule that allows CRA to challenge transactions that technically comply with the law but do not align with the underlying intent of the law. Think of GAR like this. If a rule is designed to prevent a certain outcome and a structure is arranged to technically comply with the wording while still achieving the same outcome, GAR allows CRA to step in and address it. But in this case, the court did not rely on GAR. The decision was entirely based on Section 160. Now, stepping back. The company earned the gain. The company owed the tax. The company did not pay the tax. Value moved to the owner, and the court concluded that Section 160 can follow that value. Now, for business owner, the takeaway is simple. If tax is sitting inside the company and the value is coming out at the same time, personal liability can follow. The key is to look at the structure through economic reality, not just legal form. At Cloudiverse CPAs, we help clients evaluate structures in advance, model after-tax outcomes, and identify risk before they turn into assessments. Because once Section 160 is triggered, the discussion shifts from planning to recovery, and flexibility becomes very limited. The court's message in this case was very clear. If value leaves and tax stays, CRA will follow the value. Thanks for watching, and I'll see you in my next video. Until then,